Have you ever felt like the market is playing games with you? You take a trade, watch it immediately go against you, only to see it skyrocket in your predicted direction just seconds after you stopped out? Or worse, you take a small profit and spend the entire day watching that same trade climb higher and higher while you're sitting on the sidelines with regret eating you alive. Oh no, we've all been there. What if I told you that your real problem isn't your indicators, your strategy, or even your psychology? It's your entry. That's right, the most overlooked yet most powerful skill in trading is mastering your entries. And today, I'm about to show you something incredible, a way to predict future chart patterns long before they actually develop on your screen. Sounds impossible? Let me prove it to you. Take a look at any typical chart pattern cheat sheet you can find online. You've got triangles, double and triple bottoms, wedges, head and shoulders, flags, all of the classic patterns traders study for years. But here's what 99% of traders don't notice about these traditional patterns. Your entry point is positioned way too high on the pattern. Think about it for a second. If you're trading on a 1 minute or 5 minute chart, just a few minutes before that recommended entry point, that same asset was trading significantly lower. What does this do to you as a trader? It makes your target prices and stop losses extremely condensed. Your risk to reward ratio becomes terrible because you're entering too late in the game. But what if I told you there's a way to get accurate signals that allow you to enter down at the bottom of the move, with your stop loss safely positioned underneath, and your target price at the same exact location as traditional methods? This approach reduces your risk exposure, expands your profit target, and does it with 80% accuracy. Here's how this game-changing technique works. We only need to identify a series of 3 specific candles, and it's that simple. First, we have a lead candle. This is a bold, robust, strong candle that draws our attention to the setup taking place. I know you've seen these dramatic candles before. They probably freaked you out. Here's the secret. That's exactly what they're designed to do. The second component is the confirmation candle. This candle confirms the legitimacy of the buyer who stepped in and purchased during that dramatic red candle movement. We need to verify their seriousness and legitimacy before we risk our hard-earned money. The third and most crucial element is the execution candle. This candle signals that a pivot is about to take place, and we need to position ourselves as quickly as possible. This is where our risk versus reward reaches its absolute best. Super low risk with incredibly high rewards. Now that you know the lead, the confirmation, and the execution candle, the next step is finding them quickly across markets. I use Flux Charts for that. The screeners highlight where price is approaching key areas, so I can focus only on high-quality spots. They also have backtesting tools that let you build totally custom strategies and test them against years of market data in seconds, so you know if a strategy actually works before you risk a single dollar. And here's the best part, 90% of their indicators are completely free. That's crazy, because most platforms don't even give you one good indicator for free. On top of that, they host daily live trading classes where they teach you not just how to use their indicators, but also how to build complete strategies, manage risk, and improve your overall trading skills. And if you can't join live, they've got a full library of recordings and resources so you can catch up anytime. And honestly, I just love the name, Flux Charts. Flux Charts. Flux Charts, Flux Charts, Flux Charts. If you want to try them out, click on the link in my description and use code TradingNotes15 at checkout for 15% off. Okay, let's get back to the video. Let me show you exactly what this looks like on a real chart. Here on your screen, you're seeing a chart of this pair and this time frame, but it doesn't matter what you're trading or what time frame you prefer. Whether it's 1 minute, 5 minutes, 4 hours, or daily charts, this concept works across all markets and time frames. This chart spans 2 days, and you can already see some basic pattern recognition taking shape. Notice those series of ups and downs creating what looks like check marks across the chart? Over these couple of days, the price didn't grow significantly. It stayed compressed in a range, which is completely normal for most assets. But here's where it gets exciting. Let me break down each one of those candles and explain exactly why they happen and how this knowledge is going to make you serious money. Let's focus on the rallies. If we mark the very top of this rally and retrace it back to its origin, you'll see it started right down here. If you had a time machine and this chart in front of you, that's exactly where you would want to enter, at the very bottom of that move. Now here's the million-dollar question. What do you see before those candles develop? As traders, we can't figure out the direction when we're already at the top. We're too late. We need to identify it down here at the beginning. Take a close look at the price action before this move happens. You have a series of lead candles creating what I call a flush move. Here's what most traders don't understand. This movement is engineered. It's there on purpose. This is why you see these patterns so frequently across different charts and time frames. timeframes. These dramatic moves are designed to stop out rookie and new traders. You've probably heard market terminology like liquidity, market structure, stop traps, or stop running. All of these concepts play a role, but what you're witnessing is an engineered move specifically created to generate liquidity and excess inventory, allowing larger participants to enter their positions. Here's how you can recognize when this is happening. Notice what occurs after these dramatic lead candles. You'll see this kind of candles with distinctive wicks or engulfing patterns that show buying is actually taking place. Look closely at the tails of these candles. They're matching. This means over a 10-minute span, there were several attempts to push the price lower, but guess what? It didn't happen. The reason it's not breaking lower is because that big buyer is taking small positions. Nibble, 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 like they're running an algorithm, just chipping away consistently. Now, this could be a fake out. We all get fooled occasionally and the price breaks through anyway. But right here, you're going to see the confirmation candle appear. After 15 minutes of volatility and shaking out weak hands, the price refuses to go any lower. That's how you know the lead candle created the panic and fear necessary to get rookies to sell, while the big institutions come in and accumulate those positions. The price stabilizes over 10 to 15 minutes, and then suddenly, boom, there's this beautiful candle signaling our entry opportunity. We want to position ourselves right at the tip of that execution candle. You could have caught another entry right there on that small pullback with your stop loss positioned safely below. Now compare this to your typical flag pattern entry, which would occur much higher up in the pattern. That traditional entry would probably make you some quick scalping money. But look how that trade fatigued quickly compared to the massive move that was available earlier. Let me show you the second rally to prove this isn't just luck. If we mark the very top of this secondary rally and trace it back, you'll see the exact same setup. Before this rally begins, you have your lead candle creating an almost identical pattern, followed by the confirmation candle, and then the execution candle. Look at these two setups side by side. They are virtually identical in their formation. The market handed you this same trade setup in the morning. Then about an hour later, it presented the exact same opportunity again. This is how consistent and reliable this method can be. But here's the crucial question that separates successful traders from struggling ones. How do you develop the confidence and courage to jump into these trades when everyone else in the world is running scared? The answer is simple yet powerful. It's all about levels. What if I told you there's a predictable spot on every chart every single day where these exact candle formations are most likely to appear? There absolutely is. Let me show you exactly what I mean. Going back to that first rally, I'm going to draw a line at the very bottom portion of that pattern. When I zoom out of the chart, you'll notice this level wasn't a secret. In the pre-market session, the area was being challenged and tested. If we look back further in time, this level probably matches another significant area where there was a cluster of previous activity. This is how levels help us with our trades. When you see that lead candle beginning to move downward, your eyes should immediately focus on these predetermined levels. That's where you should be looking for your confirmation candle, because the speed at which these setups develop can be incredibly fast, especially during high volume volatile situations. Watch how the price comes right into that level area, and that's precisely where the reversal takes place. The second move created a slightly higher low but remained very close to that same critical area. What made that move special in terms of levels is that it provided extra verification that the large buyer had returned to the market, making it extremely difficult to break that support cycle for the day. If I examine the other day and expand the view, you'll see the same phenomenon. All of these significant moves are occurring at predictable levels. They don't have to be exact to the penny. I've always said technical analysis isn't literal, but you can clearly see they're all coming into specific zones or ranges. Here's something most traders miss when it comes to levels. Notice that in the pre-market sessions, you get these warning signs. About an hour before the market opened, there was already downward pressure attempting to break lower, but somebody stepped in with high volume purchases. This can always disappear at the open, but what I'm highlighting here is crucial. These specific candle formations cannot appear just anywhere on the chart. For example, you cannot buy that candle up there in no man's land because there's no support structure underneath it. The nearest support level is way down here, and the nearest recognition of large buyer interest is at these predetermined levels. Any entries you attempt in unsupported areas are extremely dangerous. This brings us to the third element that ties everything together, and I'm surprised more traders aren't aware of this game-changing factor: timing. Just like levels, the timing of these moves is like clockwork. They're routine and happen every single day. When you combine proper timing with the right levels and the correct candle formations, you have context, power, and meaning that puts you in the driver's seat for consistent profits. Let me show you what I'm talking about using this same chart. Notice when these moves happen, between this time and this time, then another significant move around this time right after the lunch session ends. Here's the incredible pattern. Every 30-minute interval, you're getting some type of pivot. You get that early pivot within the first 30 minutes of trading, followed by a rally that may last an hour, then another pivot that may last an hour, followed by yet another pivot lasting about an hour. Move to the next day and you'll see approximately the same timing pattern. There's a move right after the market opens. You rally for 30 to 40 minutes, pull back for 30 to 40 minutes, then move back up for another 30 to 40 minutes to an hour, and the pattern continues. Now, this isn't a 100% guarantee, but here's what you need to understand about timing. When the market opens each day, the highest level of activity takes place in those first 30 minutes. That's where all the institutional games get played, where all the premium levels get established for the day. After that initial period, markets tend to develop a rhythm. They settle into a pattern, and the moves become much cleaner and more predictable. Now comes the moment we've all been waiting for. How do you actually use this information in real-world trading? All of this theory sounds great. You understand the candlestick patterns, you've grasped the importance of levels, and you recognize the timing elements. But the ultimate question is, how do you put this into practice in live market conditions? Don't worry, I'm going to demonstrate this with an actual trade example right now. I want you to observe each step independently. First, watch for the lead candle and how it raises our awareness toward the setup. Next, we'll plan out those critical levels by looking to the left side of the chart for clues about where that big buyer will step in as our guardian angel in this trade. Then, pay very close attention to my execution timing. The trade I want to analyze is this one, during CPI data release. I'm using this specific example because it highlights not just the power of this strategy, but how it works even in the most extreme market conditions. If this method can work during major news events, it can work in any market situation. I'm going to use the TradingView playback feature to walk you through this step by step. As the CPI data was released, you can see that dramatic lead candle formation. While the news generated that specific candle, it's important to understand that these patterns occur frequently even without major news catalysts. When you see that lead candle developing, instead of panicking like most traders do, the first thing you need to do is look to the left side of your chart. If I zoom out, you'll notice there's a significant reason why this asset chose to bounce at that area. Making this chart smaller reveals several previous buying zones right in that vicinity. There's a strong probability that somewhere between these levels, someone is going to attempt to accumulate positions. Here's your first clue from the lead candle. Examine that very first candle carefully. You'll notice there was indeed some pickup activity. Not a massive buy order, but there was definitely some institutional interest showing around this level with effective buying flow. The next candle does make a slightly lower low, and this is exactly why we don't place stop losses directly under the previous low when trading in general. The market may trade through that level briefly and print some lower prices, but notice how it gets picked back up quickly. These clues are very subtle, but they're occurring at exactly the right technical level. If this same activity happened up here in an unsupported area, you need to be extremely cautious, but it didn't. The selling pressure brought the price all the way down to our predetermined support level. Moving forward about 10 to 15 minutes, you have several factors working in your favor. You have the element of time working for you because this market refused to continue lower. It didn't gain significant upward traction yet, but more importantly, it stopped declining. Why? Because the market is doing exactly what we discussed earlier. Institutional money is nibbling away at those buy orders down in that support zone. At this point, the price could still break the low. It might just be preparing for another downward leg. That's why we need that confirmation signal. And the more candles that develop without breaking lower, the stronger that confirmation becomes. Here's the execution candle. As subtle and slow as this movement appears, this is our entry signal. Most traders would not take action at this point, but let me show you why this is the optimal entry. Look at these three wicks at the base of this chart pattern. They all held support right at that exact spot. Those three wicks provide the easiest confirmation that our big buyer is present and active. If I buy right here, which is exactly what I did and very close to my actual entry point, I have everything to gain and practically nothing to lose. Some people ask, how do you know for certain? The truth is, you don't always know with 100% certainty, but successful trading isn't about winning every single trade. It's about probabilities and risk management. I have enough technical data telling me this is probably going to be the low of this move. If I trail a stop loss down there, I'm only risking a small amount. But look at the potential target. This setup has the power and potential to move significantly higher. And when you have such favorable risk versus reward ratios, you're ultimately going to be profitable over time. Using a risk to reward calculator, you can see we have approximately a 3.3 to 1 risk versus reward ratio. These are exactly the types of trades where you have everything to gain and very little to lose. Continuing the playback, you can watch how the price steadily ground its way higher toward those resistance levels. I actually sold my position up in this area. And here's another crucial reason for using this method. When you have this much room for the asset to move in your favor, it allows you to capture substantial gains. If I had bought this up at this higher level, I most likely would have been stopped out because I couldn't couldn't handle the normal pullbacks that occur during trends. If we continue playing this forward, you'll see the price eventually worked its way back up to those target levels, not without some pullbacks along the way. But you cannot survive those pullbacks if you're chasing rallies and entering too late in the move. That's the true power of this method. It positions you where you really don't have to worry about your risk because it's so minimal. This is exactly how you should be approaching every trade. Risk first, reward second. This particular trade might not have reached the absolute top of the move, and that is perfectly acceptable. It's much easier for me to manage a trade when I've bought it down here at an optimal entry. If it stops me out, that's fine. It's much better than buying up here at an inflated price and then getting stopped out for a much larger loss. This is the key insight that most traders and most technical analysis strategies miss. If you follow traditional methods exactly as they're written, they're getting you into trades too late in the move, and that's precisely why you're not generating consistent profits. Whether you decide to use this method, the checkmark pattern, or some other strategy you're currently working with, I always encourage you to focus intensely on levels and timing. Really examine these charts without any indicators cluttering your view, and develop a feel for pure price action. If you pay close attention, you can identify those big buyers and big sellers, and you can find the proper areas to position yourself where risk and reward ratios are extremely favorable. Thanks for watching, and see you guys next time.